In today's world of finance, equity is a very well-known term. Equity in accounting and finance refers to the value that may be attributed to a company's owners. The market value of equity is based on the current share price, if it is publicly traded, a value established by investors, or a value assessed by valuation experts. The book value of equity is computed as the difference between assets and liabilities on the company's balance sheet. In today's video, we will learn about the equity in simple language. At Finance Doc, we will be sharing more explanation videos related to cryptocurrencies, trading, forex and many more. So watch this video till the end and hit the subscribe button and click on the bell icon to get notifications for our future videos. So let's begin the video. Equity, also known as shareholders' equity or owners' equity for privately held companies, is the sum of money that would remain in the hands of a company's shareholders in the event that all of its assets were sold off and its liabilities were fully settled. It is the worth of company sales less any obligations owing by the company that were not transferred with the sale in the case of an acquisition. Additionally, a company's book value may be represented through shareholder equity. Equity may occasionally be given in exchange for cash. Additionally, it symbolizes the proportionate ownership of a company's shares. One of the most common types of data used by analysts to gauge a firm's financial health is equity, which may be viewed on the balance sheet of a corporation. How shareholder equity works. The assets minus liabilities shareholder equity equation offers a clear picture of a business's finances, easily interpreted by investors and analysts, by comparing specific numbers reflecting everything the company owns and everything it owes. Equity is defined as a company's capital that is raised and then utilized to fund operations, invest in projects, and buy assets. Typically, a business can raise capital by issuing equity or debt, such as loans or bonds, by selling stock. Equity investments are typically sought after by investors because they offer a better chance to participate in a company's growth and earnings. Because the value of an investor's stake in a company is represented by the percentage of its shares, equity is significant. Shareholders have the opportunity for financial gains and dividends if they own firm shares. Having stock entitles shareholders to vote on business decisions and board of director elections. These advantages of equity ownership encourage shareholders' continuous involvement with the business. Equity held by shareholders may be negative or positive. If the answer is yes, the company's assets exceed its liabilities. In the event that this balance is negative, the corporation is said to be insolvent on the balance sheet because its liabilities exceed its assets. Investors typically consider businesses with negative shareholder equity to be hazardous or unreliable investments. Investors can effectively assess an organization's health by using shareholder equity in conjunction with other tools and measures. Shareholder equity alone is not a reliable indication of a company's financial health. Key takeaways. Equity represents the value that would be returned to a company's shareholders if all of the assets were liquidated and all of the company's debts were paid off. We can also think of equity as a degree of residual ownership in a firm or asset after subtracting all debts associated with that asset. Equity represents the shareholder's stake in the company, identified on a company's balance sheet. The calculation of equity is a company's total assets minus its total liabilities, and it's used in several key financial ratios such as ROE. Home equity is the value of a homeowner's property, net of debt, and is another way the term equity is used.
Thank you for watching this video. If you like this video, don't forget to hit the like button and subscribe to the channel so that you don't miss out on our upcoming videos.